All right, the day is here. The Federal Reserve made their decision. Half point rate deduction, 50 basis points. Nobody expected that, right? The probability said it's probably going to be like a quarter point. And we got a half a point. And I went ahead and I read the meeting notes that the Fed releases. And then I also read a, or I watched the presentation by the Federal Reserve Chair Jerome Powell, and had some good information. And I'm going to go ahead and just share some of it. So from the notes that they released, their press release, it said just the main points here. It said even though the unemployment rate has actually gone up, the it's still low. It's still pretty low. I think they said it was like, and I'll have the note here, but I think it's like 4.2% or 4.3%. So it's in a good place for the unemployment rate historically, right? I mean, I think full employment is like around 3 to 4%, so it's right there. Then it says says inflation has advanced. They've advanced toward their 2% objective, right? Because they have a 2% inflation objective to get to, and they've gotten really close to that. And I'll share where they're at right now. But it's still just a little bit elevated from where they want it to be. They have two mandates, right? So they have maximum employment and they have stable prices. And right now, for the last 2 years or so, they were really focused on stable prices, right? Because inflation was out of control. But now they're switching to focusing more on maximum employment and just try to find the equilibrium between the two. So that's by cutting rates, they're going to hope that people, companies, and people continue to spend money, to borrow, to invest, and that way people still maintain their jobs, and the economy continues the pace that it's been going through, which is growth, right? The United States economy is still the most powerful economy in the world right now. So they did a half of a point. So the range is going to be 4.75% to 5%, right? So that's where they're going to be focusing on now instead of before. With the Fed funds rate, this is not the 30-year rate, and I'll talk about that at the end of the video, where that's at and where it was. But it said everything is going to be based in the future on incoming data and the evolution and the risks that come forward. So they've been continuously saying that there's no specific plan. They do have probable outcomes of where the Fed rates are going to be at the end of 2024, 2025, 2026, and beyond. And I'll share that in a few minutes. But in the end, everything's going to be based on incoming data. Things could change if the economy changes, inflation gets out of control, and so many other black swan events. Then it says the committee is still monitoring the implications of incoming data, and these projections are considered very. It's just they're not. There's no guarantees for this. So just mention that at the end of the document. Considerable uncertainty is the word that they use. All right. So here are my notes from that was from the press release, and here are my notes from Jerome Powell's meeting. And he shared a lot of good nuggets there. And then yesterday, the markets really didn't go crazy with that information. But the markets, I mean, if you follow Warren Buffett and you read, or The Intelligent Investor, if you ever read it, you hear about his story about Mr. Market. Mr. Market, sometimes he's happy and sometimes he's mad. And it just, you don't even know why. So the market today, it's exploding. It's like 300 up on the Dow. Yesterday, I think it went up a little bit, then it came down. So hard to pay attention on the market, but I'll mention a point on that later. So they did a half a point cut. Inflation is at 2.2%, so just slightly over their 2% target right now, which is, it's right there again. We've gotten to a big point. I think inflation got to like 7%. Unemployment rate's 4.2%. Expected growth rate for the economy, and this again is the median from all of the Federal Reserve participants, the Federal Reserve governors. There's like 12 people on the panels, and they each give their likely outcomes, and they all, on average, for the median, it's like about 2%. The investments actually are higher this year than last year. I believe we talked about intangibles there. every decision is going to be meeting by meeting. And for the half point cut, it was out of 12 Federal Reserve governors, 11 voted for the half point cut. One person did not vote for it. They wanted a quarter point cut. So a lot of consensus building there. Big majority voted there. Then you have the U.S. economy is in a solid condition. This is what he said. And they're not behind on cuts. And they asked this question because people were saying, are you doing a half point cut because the economy is not in good shape? Basically, we're going into recession. You're trying to save the economy. And he specifically said no. He said, even though if we would have had data a little sooner, maybe we would have done cuts before. He said, right now, the economy, the place that it is, I don't foresee that there's going to be a recession in the short term. There's no signs of that. Anything could happen, of course, but there's just no signs of that. It's expected for 3 cuts in 2024, so another half point potentially in 2024. Whether that be a quarter point, but that's based on the data right now, and then 200 basis point worth of cuts in 2025. I think that's huge. That means they're probably going to be going to like around 3% for the Fed fund rate in 2025, at the end of 2025. Then we have, someone asked about housing inflation. I think that's a good one. Being a lender and a real estate investor, that's one I care about. And it says housing inflation is dragging, actually. And it says one of the things they're focused on is market rents, and they actually have been growing at a slower pace than before, which was a positive. But then the other part was housing regarding for sale housing. And he said there's just not enough housing to keep pace with that. And then, I mean, the numbers with that, I think we're behind like millions of units of housing all the way back since the Great Recession. We're not building enough housing, specifically in the areas where people want to live. There may be housing in certain states or certain cities where people are moving out of, but the places where people want to live, there's just not enough housing and not being built as fast. And we can get into that in another video why. No major signs of recessions are imminent. I wanted to make sure to mention that. And these are some of the final points regarding the numbers. So we're number heavy here. The 10-year Treasury, right, which is what the 30-year mortgage rate is based on, it was at 4.93 at the peak. And we're talking about around October of 2023. Today or yesterday, it was around 3.70. So big difference. I think today this morning it was like 3.75, but still more than a point lower than the peak of last year. And then the 30-year rate, the peak was around 8%, 7.79%, depending on what you look. But today I looked yesterday, actually afternoon, and it was 5.375%. And of course, mentioning interest rates, probably looking at an APR a little bit under 6% there. And just using a $400,000 purchase, 320 loan, 30-year, no prepay, some of those details there. We just wanted to disclose. And then median rates for the Fed funds rate in 2024, they expect to end at about 4.4, right? So that goes with the 2 cuts, another half point. At the end of 2025, about 3.4, right? So I don't know why it said 200 basis points. I guess it's 200 basis points, including this year and next year, right? Because that'll be just 100 going down to 3.4. Then 2026, we have 2.9 percent, right? So the Fed funds rate. So that's another half point in 2026 to cut. And then it's just going to stay like that for the near term, depending on how the economy plays out. All right. So good news for the economy. If you're looking at buying a home, if you're looking at getting a car loan, if you're looking at getting a loan for your business, you're going to be happy because interest rates are going to go down on all those products. But it's going to happen slowly. There's a drag or a lag effect for rates to come down. Rates today, they had already factored in some of that 25 to 50 basis point cut. So you're not going to see that in the short term. The bad thing is if you have a high yield savings account, money markets account, which I do, those accounts are going to start reducing their interest rates. And there was an article about that it does take some time. It doesn't happen right away, but there will be some deductions there, which is not a good thing. And then of course bonds, maybe the bonds that you currently have are probably going to go up in value because the rates are going to go lower for new bonds, right? So that'll work in the opposite effect. All right, So we have that. That's for the Federal Reserve. I hope you got a lot of information on there and you benefit from it. And if you did, do 4 things for me. Simple, easy. Subscribe to this video. Subscribe to my channel. Give it a thumbs up. It's easy. It's just thumbs it up. Put a comment on there. You know, it's for the algorithm, right? The algorithm likes it. And then the last thing is share it with 10 friends, right? Share it with 10 friends. I'm a lender, mortgage lender, buying a house, investment property, and a investment advisor. If you're looking to put capital to work in real estate investments, whether that be via lending or participating in a real estate project that's professionally operated, would love to work with you. Denny Troncoso, Coso Capital Group. Talk to you soon. All right, take care. Bye-bye.